third meeting of the year, and this is the last meeting of the year. And for those of you that are new to the group today, my name is George Gawley, and I'm from the Farm Advisory Service, and I work here in St Boswell's. And I'm joined here today by my colleague Tiffany McTaggart. Tiffany's there in the background. And yeah, the aim of today's meeting is to understand a bit more about how we can prepare ourselves for a decade of change and, to some degree, uncertainty. Now, we've been given some certainty in the sense that farm support will remain broadly the same until 2024, which is known as the transition period. But to be honest, this is really not too far away. So with the full direction of travel still quite vague and to a large extent outside of our control, now is the time to start thinking a bit more about how we can start making our businesses a bit more resilient to this change going forward. So today we are getting the accountant's view on this subject, and I would therefore like to extend a very warm welcome to Victoria Ivinson from Douglas Home & Co. Accountants. Victoria, welcome along.
Hello.
And Victoria, would you just like to maybe start by telling us a bit about yourself and what you're currently involved in?
Yep, sure. Thanks, George. I'm Victoria Ivinson. I've worked for Douglas Hume since 2007. And I'm now a company director there after qualifying as a CA quite a few years ago. I moved on from doing just accounts prep into what we call our advisory and specialist tax department, where we really focus on proactive advice for our clients, doing succession reviews, research and development claims, capital allowances visits, anything really to try and save a bit of tax where it's all possible. And because of my background, I am from a farm, from a family farm. My dad's a farmer, and I've actually, for my sins, married a farmer. That I'm obviously a strong interest in agriculture, and always kind of focused on that side of things, albeit alongside the corporate side, but agriculture is really where my interests lie. So I head up a team of the agricultural side and the tax specialist side here at Douglas Hume. We've got 6 directors and I think about 72 staff now over around 8 offices in Scotland and the north of England. So we've grown, since I've started, we've grown massively. So we've got a good team behind us now.
Fantastic. Victoria, would you just like to try and share your screen, and I'll just let you...
I like how you said try, George.
And
you got no confidence.
Well, you can give it a
yes.
go. Hopefully it works okay.
Sure.
That's brilliant. So I'll just hand over to you, Victoria, and you can take it from here.
Great. Okay, thanks. Hi, everybody. I usually do these type of things much more informally than this and kind of have a bit of a discussion, but it's fine. We'll do the questions via, if you've got a question, just speak, or it'll pop up in the comments box and we can take it that way. So yeah, feel free to ask away at any point. I'm quite happy to stop talking and cover your point. So what I'm really trying to do is this isn't supposed to scare anybody or make everybody feel thoroughly depressed, because I did this presentation, similar one, to a bunch of farmers, and the feeling they got was they were thoroughly depressed, and that was in England, so it's a little bit different. But I try to trying to just get across to everybody that change is happening. We can't really do anything about it, but let's try and be prepared for it and embrace the change that's coming the best. So as George already alluded to there at the start, there's no real set plan for what is going to happen post 2024. We know from now to 2024 things are going to remain broadly the same with the BPS situation, but after that we don't know what will happen. It has been hinted that it will work alongside the farm model with focus on carbon sequestration, clean water and public access. And similarly to England, we think that it's thought that it will be public goods for public money. So that is where everybody's thinking it's going to go. Now, that itself could create problems, but it's just kind of being prepared for them and seeing what we do with that. Now, the EU structure, which Scotland are hoping, which we think Scotland will follow, is they have got a capping system in place. So if anybody's in receipt of large basic payment, and when I say large, I think 80k was maybe the amount, 50 to 80k, and they don't like the thought of anybody receiving over 100,000. So if your basic payment is in those upper bands, some kind of separation to split your farm unit into two businesses might be what needs to happen to avoid that cap. I've spoken to a few advisors on that type of thing, and it can work, but it needs attention now, because obviously they know if it's an artificial separation, so it would have to be different family members and different bits of the business and things like that. But that is definitely something that may need looked at for people in receipt of those larger sums of money. That obviously brings with it issues, because if you are going for a separation angle, that you want to separate the business in two, it might then impact on inheritance tax issues. Whereas the farmhouse, are you going to lose agricultural property relief and things like that? But it also might increase it, so it might be a good all-round point, because you might be able to potentially get two houses classed as farmhouses and along those lines. So it's definitely something that needs looked at if we know the capping model is going to be put in place. I would urge everybody to get some advice on that as and when we know what's happening there. So yeah, we've got general uncertainty. We've got all the issues that have been going on just now with Brexit, climate change, and of course labour shortages, which is causing no end of issues. And in the handout there, we've got just a simple checklist of things that could potentially help with those. I'm going to discuss those in these slides. So what I would suggest for everybody to do, is to be proactive now. So really understand your business and almost do a full business review of your accounts. Now, your accounts are the starting point. And as we all know, you do your accounts every year, and how useful they are to you depends on how they've been prepared, how much insight you've given to your accountant and the discussions you've had thereon. And what I really mean by that is the end result may well it will be correct. That isn't really up for discussion, but it's how you get there. So if you've got your accounts in an enterprise format, and do you really know what's making your money there? So as I've just mentioned, do your accounts reflect your true profit streams? And that first point there is saying, do you consider homegrown feed costs versus selling the crop? Now, just as an example, if you've got cattle and you feed them homegrown barley, do you do a recharge between your arable enterprise and your cattle enterprise? You might or you might not. But realistically, to actually think about the profitability of your cows, you really need to be thinking about that, because if you didn't have those cattle, you would be selling those crops and you would be getting that money in the bank. So you would be getting a more profitable arable enterprise. So things like recharges between the two, I feel, are really important to try and get into your head where the real profit streams lie. I've had this discussion with many clients, and some of them say, oh, well, we don't think about that because then we see the slurry as a cost we would have to pay if we didn't have the cattle. So there is twos and fro's on it all, but it's just to really understand, if you didn't have that in there, what would your sales be, for instance? It's just to really try and understand that. The other interesting, what opens a lot of people's minds up, interesting point there, is what enterprises require the most capital. So do you need large tractors or farm machinery if you cease to farm cattle? It sounds as if I'm picking on cows here. I'm really not. I'm just using them as a bit of an example. So trying to work out your return on capital employed. So for every £1,000 of spend on machinery, how much profit you get back on those. Now, I appreciate that's not easy to work out, but if you go strip it right back to simple terms, if you think about if you were going to lamb 100 sheep outside, you would need a quad bike and a good dog, perhaps. So your capital employed with those sheep would be very little. Whereas if you want to plant 50 acres of barley, you obviously either need your tractors, you need your equipment, or obviously you need to hire that in. So it's just trying to think, if you had £1,000, what would be your best return on that? And that's usually quite eye-opening to see the difference when you see what different income streams need that intense capital. Again, which enterprises require the most labour resource? And do you actually know how many hours a week you spend working? Well, I think everybody knows the answer to that is going to be no. And I have timeless arguments about this at home, because a while ago, a couple of years ago, I thought it would be a good idea to bring in timesheets. Everybody's sitting there thinking that sounds a little bit ridiculous. Why would I want to fill in a timesheet? But I promise you, it is hugely enlightening what those timesheets tell you. So for a start, it tells you how many hours you've worked in a year, which I don't think anybody can even, it's difficult to guess. You just do not know unless you kept those timesheets. And when I say timesheets, they're not particularly detailed. It's like an Excel spreadsheet saying I spent 2 hours feeding cows, 5 hours with sheep, some hours on said bread and fertilizer, that type of thing, with a brief description. And it is really interesting. And it allows you to really evaluate where your time spent is on. And I did this with a client, and they've been doing it for quite a lot of years. And they worked out basically that they could have 20 hours a week spare for not really much difference in profit by ending one of their enterprises. And if they then put their time into one of the other enterprises and double the production, they would still have time spare, but have so much more profit. So it really is hugely enlightening. I can't recommend it enough, although you think it sounds ridiculous. And actually getting anybody to do it is a little bit tough. But like I say, I can't recommend it enough. It lets you know what your employees are doing as well. I don't know how many of you employ employees, if you already make them do timesheets, but it really lets you know what time they're spending and how you can use them better. So you might have somebody who's great with sheep, but terrible on a tractor or something. And if you can, direct them to what they're good at, and they spend most of their time doing something, and it might work out to save you money in the long run. And then the last point there is saying, are you comfortable working for less than minimum wage? Now you can't work out what your hourly rate is if you don't know how many hours you've worked and what you've worked on. And it's just, some people will be happy working for less than their staff, but it's just to let you know exactly what you're working for, like what profits you've made over a period and what your return on that has been. So that's one I really recommend, even though it sounds a little bit crazy and a little bit, over the top, but it really is useful. And are you claiming every tax relief available to you? So that's capital allowances and R&D tax credits, research and development. I'm not going to go into them just now because I have got some actual discussion on them in a wee bit. So if you've decided, yes, I need to be proactive, yes, I'm going to embrace this change, how do you actually do that? Well, I think the first things to do is to speak to the likes of George and find out what your income gap is going to be. Well, obviously right now that's not, you don't know what your income gap is going to be because we don't know what the future is. So you're preparing for what that gap is going to be, basically, and you're preparing for the unknown right now. So to make your farm as profitable as it can be going forward, you potentially might need to change the mix of your farm. So you might need to remove non-profitable enterprises or adapt those enterprises to make them more resilient. And you might then need to have practices ready that will benefit from these changes. So something like if we know that we are not going to be able to spread certain types of fertilizer because you need to keep the nitrogen levels to a certain degree, then we might need to think about planting different crops. And again, reevaluate the use of your capital. So where is that capital employed to best use? Where can you get the rate of return best for your money? If you spend, for every £1,000 you spend, what can you make? Consider renewable energy and carbon capital. Well, that's probably a discussion on its own, the whole thing. And again, I come on to that when we're doing diversification. So yeah, diversification, that might be what you need to go down if you feel that the farm isn't going to be able to support your family or the next generation. We might need to diversify. And then succession management. So a lot of people are actually evaluating, can I face this period of change, and is now the time that I might want to pass it on to the next generation? Or do you keep farming away, doing the practices you're happy with, but you let the younger generation do diversification schemes, or they take forward, do carbon sequestration activities, or they take forward the things that you're less comfortable with. And a succession plan, I think, again, is an absolute must, and it's never too early to start thinking about that. Things like, where is everybody going to live on the farm? Have you got enough properties? Where does everybody want to live, and what does everybody want to do? I'm a real big believer in the round the table family meeting, asking those awkward questions. Nobody wants to do it, but it's where you make strides forward. How many years do people go on not knowing actually what everybody wants to do? And you can sit around that table and have it out almost. It can be a real great tool. So really, in terms of preparing for the changes that are in front of us, 2024 onwards, I feel the message has to be, it's take action now and embrace the change. Try and really know your business, really know where you could make some savings, where you could make some additional profits, and what you could do to change your current situation. That leads us nicely on to diversification. So I don't know how many of you on the call today have diversified and have, whether you've went down the renewable energy route or first holiday lets or tourism at all. Quite a lot of farms now have got at least an element of diversification within. And what I always say to everybody is, please seek advice right from the get-go. As soon as the idea lands on your lap, think, right, I need to speak to somebody and get some advice on that. Because if the structure isn't correct, then it could be really, it could cause problems. So it could cause problems, whether it be inheritance tax problems when you pass away, or you could be just walking right into a VAT liability that you haven't really envisaged, or capital gains tax liability that you hadn't really thought through, or it could just cause a real headache when it comes to doing your succession plan and dividing up the business. It's now the time to think, right, I'm going to ring fence that business, and I'm going to put another fence around this one and bring in different generation and let them lead with the new ideas potentially. Just a couple of diversification points. So on the accommodation side, so if furnished holiday lets in caravans. Now, everybody would probably tell you that rental income is exempt from VAT, which it usually is. But furnished holiday lets are completely different, and they actually are standard rated and chargeable at the standard rate of VAT, which is 20%. So if you're running that through your farm partnership, which is VAT registered, and you're charging £100 a night, let's say, you've lost a sixth of that to the VAT man, which you hadn't really thought of. This, I can't tell you how much this happens. It happens so much, and it's really it really annoys people because they think, "What? That's unfair." But there is ways around it. If you deal with it at the beginning, or even if you're in that situation now, there is ways that you hive off that those properties or those caravans, potentially caravan site, and get them into their own little, or it might not even be little, it might be a big entity, as long as it was under the VAT threshold, which is around 85k, you would be able to ring fence them there within their own little unit and avoid VAT, basically. That's something that I think everybody really needs to think about. In capital allowances, this is very often missed, that capital allowances can be claimed on furnished holiday let properties. So if you've had a property for some time and you've ran it as a furnished holiday let, there may be what's called embedded capital allowances. So that's things such as your light switches, your kitchen units, plugs, lights, every kind of fitting you could think of, go as far as like door and window furniture, every lots of different things that you can claim capital allowances on, which obviously then reduces any tax liability. And that is often overlooked, and in certain cases can be, massively substantial. The other point to raise on that one is the inheritance tax position if you've diversified into holiday lets and caravans. So people, again, feel a little bit unfairly done to in this one, because they say, I'm running it like a business. I have to clean it. I have to meet the guests. I have to, I'm on the phone to them if they've got a problem. I might book them a taxi, that type of thing. But unfortunately, generally speaking, there is an odd case out there where the defendant has won. But generally speaking, furnished holiday lets do not qualify for any inheritance tax relief. So if you've included them on your farm, it might be another reason to hive them off into a separate entity, or maybe keep them within the entity, depending on the situation, to preserve or to get inheritance tax reliefs. Because if you're just for a point there, if you've got a property and its value is because property values are rising, if it's a high value property bringing in a good revenue, if your farm in activity was reduced for some reason, you didn't have a lot of activity going on there, it wasn't making a lot of profit, you might have the problem that you were to tip the scales. So what happens there is your investment activity, which is your furnished holiday let, would go above the profits and the incomes of your farm, and then that would cause a real issue where the farming unit itself would struggle to qualify for every inheritance tax relief out there. Now, there's ways around that as well, and I'm not trying to scare anybody, but my message to you is really seek advice before just diving in to do these things and get the structure right, because it can quite quickly have an effect on you and your return before you really realise. The next one up, renewables. Lots of people have gone into renewables, and I see many a time quite big problems, that people again have just gone in there and not thought about it. So the first one there is, if it depends on whether you have bought the renewable kit, so to speak. So have you put your own wind turbine up, or are you leasing ground to the wind company? Now, more often than not, people are leasing the ground, which gives you high level return for the rental income. But that's obviously causing a problem again, because that's bringing an investment activity into your trading business. And what does that do to your skills again? Are you trading profitably enough that you can keep trading side above the investment side, or do we need to take steps there? Again, on the renewables, the VAT side is sometimes an issue. So people might put a biomass boiler in and do self-supply to themselves. Now, that's fine as long as you are doing a self-bill invoice and you're suffering personally the VAT. Because what you need to think about is VAT can only be reclaimed on items that are wholly and exclusively for the purposes of your trade. Now, if you've reclaimed all the VAT back on your installation of your boiler and everything else that goes with it, that's a full VAT reclaim, so that's fine. But if you then are using it wholly for trade and you're using it for private items, whether it be self-supply to your house or it might be heat to rental cottages, you've got a problem. It's easily combated. You just need to think about charging VAT, which is on the 5% rate, because it's heat. So it's not a disaster, but you do really need to think about that one. Again, with capital allowances, these items are costly. You're claiming all your capital allowances. If you're not then billing for the private use of that, then you're potentially needing to restrict your capital allowances claim. So that one happens regularly, and we've had a few inquiries into those exact situations. And if you don't have those, those level of procedures in place, that falls foul to the revenue rules there. I'm just keeping going. Has nobody got any questions? I'm assuming not. Fine. The annual invest. Oh,
I've got some questions there, Victoria, but I think I'll just leave them to the end and just
that's fine. No problem.
Keep going if that's okay.
Yeah, grand.
But if anyone wants to jump in at any time, they can if they want to ask anything specific. That's fine.
Okay, so moving on to the annual investment allowance. Now, this one gets a lot of press because this is the amount of tax relief limit you can claim on plant and machinery. They increased that to £1 million in 2019, and they just announced in the budget that they will extend it to March 2023. So that means if you spend up to £1 million on kit, you can have 100% relief of it against tax. Now, that also applies to integral items. So what I mean by that is, when I was discussing the embedded capital allowances within your furnished holiday lets and things, maybe it might also be the internal structures of your sheds, for instance. They would also qualify for annual investment allowance, whereas the written down allowances are only 6%, but in the first year you could have 100%. So it's a really good way of getting the allowances for those up front before the 6% kicks in. Now, the super deduction has sparked a lot of questions and a little bit of confusion. So the government brought this in, and everybody thought, "Wow, that's great," which it is good, but it has caused several problems. So the super deduction, firstly, is only available to companies where they have got qualifying plant and machinery. So that's the first one. If you're a partnership or a sole trader, I'm afraid you can't claim the super deduction. Now, it's open until March 2023, and it's only available on brand new items. They can't be second-hand or leased. Now, that again has caused a few problems. You also have to have the kit delivered by 3rd of March 2021. So, yeah, that can be problematic. Now, the real issue we've got with the super deduction is what happens when you actually sell those items. Now, this isn't something you need to worry about if you're buying something that you're going to keep for a very long time, but which isn't always the case. If you're buying something and then you'll later trade it in, when you come to dispose of that item, you don't just you get the disposal in terms of your capital allowances calculation is 1.3 times the disposal value. So that can cause some problems. So just to give you a wee idea of how it works, if you buy that tractor for 100 grand and you trade it, so on day one, in the end of year one, you claim tax deduction of 100 grand. Great. No tax to pay, wiped out all your profits. That's you've had your relief. But let's say 4 years down the line, you just decide to sell that tractor, and that tractor is now worth 50 grand. You've already had relief of 100. So that 50 grand comes back into charge. But if you've claimed the super deduction, it's now 65,000 comes back into charge. So you've then got a tax bill of 12 grand rather than the deduction you had at the beginning. And some may say it swings and roundabouts, but it's quite often forgotten about. People think about their capital allowances, about, oh, brilliant, I've bought kit this year, I've got a tractor of 100 grand, but they don't remember about the trading. So you've actually only got tax relief on the term between the value of the purchase and the trading. That's something to be mindful of there. Leading on to research and development. So I don't know how many of you will be interested in this. I'm not sure how many of you are trading through limited companies. Because research and development is only available to limited companies. Unfortunately, it isn't available to sole traders and partnerships. But if you do feel as though you're doing it within your sole trade and partnership, it may be a reason to incorporate, to be able to claim the research and development relief once incorporated. So it's maybe a pro of incorporation, something to think about. So what is R&D? So it's to incentivize business to basically innovate and problem solve. So this has been pushed for quite a number of years. It's not new. We've been doing it for around 8 years, I think. And we've been claiming R&D relief over a mass of industries. just sticking with agriculture, we've claimed them within arable enterprises, cattle, sheep, dairy, poultry businesses. We've got some on like biomass boiler clients. We've got a massive array of these allowances out there, these claims out there, sorry. And what it means is you're already getting tax relief for the spends that you've spent on these projects within the year. So let's just say, for example, if you've spent £10,000 on qualifying work, you've got that 10 accounts, you've already had 100% relief. But what this means is you can have an additional 130% relief. So from your £10,000, you would have a £13,000 deduction, which would then result in a tax saving of £2,500. Now, what's really interesting is you actually don't need to make a profit. So if you are loss making and you're doing research and development, which if you think about it, most businesses that are research and developing in their infancy are loss making. The revenue actually pay you to cash in your loss. So if you've got a loss of £10,000, the revenue would pay you 40.5% to cash that loss in and physically give you a repayment of £1,450. Now that's great. And we've got a few pharmaceutical companies that do this repeatedly. And we're in, year 6, 7 of losses, and their only income has been their tax credits from the research and development claims. Now, they're extreme cases, but it's an absolute godsend for the cash flow of businesses if they're losing money and we have R&D qualifying activities in there which they could be getting some cash back from. Now, it's very ambiguous legislation surrounding R&D, and there's books and books of it. But what broadly qualifies is there's 3 things. So you've got to be able to prove that within your sector, you are making an advancement in science or technology. Number 2, you're making an appreciable improvement in the fields. Or number 3, you're solving a trade secret. Now, you've got to be able to demonstrate that you've done one of those 3 topics. Now, that sounds very difficult to relate to, and you think, well, I'm not making an advancement in science or technology, and I'm not particularly making an improvement in the field. But if you think of it like this, the 3rd point there, it says solving a trade secret. Now, how are you going around your everyday working environment? You're probably having to solve problems all the time. And you might see it as it's not solving a trade secret, but how I try to explain it to people is, could you Google the answer to that problem? Now, that might sound a little bit ridiculous, but pretty much everything is out there ready to find on the web. Now, you can find the solution to a lot of these problems within agriculture because they're very specific to the environment that we're in, within the climate that we're in, within the region, within the soil type, within a massive different variance. So within that, you are having to solve a problem that nobody knows the answer to. So are you solving a trade secret? You might be. So what I'm trying to say is the R&D potential is huge, and if you've got qualifying projects, you might be missing out on tax relief that you've not thought of. Now, the types of things that do qualify, and if anybody's interested, in the farming ones, I can send them through some fact sheets. I've got some on agriculture, dairy farming, and poultry businesses. But just for sticking with the crop side of things, are you making improvements to harvesting techniques? Are you doing new disease-resistant or livestock? Are you doing gene transfer technologies? Are you trying to increase your crop yields? Are you doing, trying to move get antibiotic free are endless. There is so many different things to think about. I've just been doing one with some poultry farmers that have got egg production, and they're trying to, improve the shells on their eggs. So they're trying to make them stronger. And how do they do that? Or another thing might be, feather cover of birds. And how do you help your birds keep healthy with the feathers and things? So as you can see, there's a mass in there, and we could probably talk about it for a long time. But I'm going to stop there and see if anybody's got any questions that I could answer on those topics.
Yeah, thank you so much for that, Victoria. I'll just dive in here. We've got a couple of questions come through. First one, I suppose, is going back to the capital allowance of £1 million. It's obviously very easy to go out and buy a new tractor, but are there sort of maybe some other examples of capital allowances that are maybe sort of less well known that might help us adapt to change? Obviously, I'm not saying it's wrong to go and buy a new tractor, because we all
but you've got to spend a lot of money to get the allowance.
Tractor, but sort of what other examples are there that are maybe less well thought of?
So one point there is there was case law, I think it was in 2020, that changed a lot of the capital allowances rules. So previously to then, any fixed structures within your farm didn't qualify for capital allowances. And I think everybody's well aware of that. If you build a shed, very sorry, but that's a structure. You can't have your capital allowances. It's a capital spend. But what this case did was change that thinking. So capital allowances are available on, let's say, a grain site. A standalone grain bin, that would qualify for capital allowances. And what happened in this shed case, they said, well, what's different to my shed that's going to house my grain to that silo that would house the grain? They said, my shed is built for temporary storage. It houses my grain. I've got a ventilation system in there, a moisture meter. It's definitely a grain housing shed. Why can't I have capital allowances? And what HMRC determined was they went on the side of the farmer, and they allowed him capital allowances on his shed. And there's three bases to that. So you have to be able to prove that it's a temporary storage facility. So i.e., it has to be empty for some point of the year, and then it has to be cleaned out. So if you can say that's a grain shed, only a grain shed, I keep grain in it 10 months of the year, it's empty for 2, I clean it out, I don't do anything with it after that, i.e. I don't store any tractors in it, or I don't do anything in there, that's 2 ticks. The third one is it has to have a special feature. So has it got some kind of special feature within that shed which could bundle it up as a temporary storage facility? And that ticks your boxes to claim capital allowances on its entirety. Now, I'm sure you can appreciate how massive that one is, especially if you are an arable farmer that's putting up, some pretty considerable big grain sheds. That's going to save you a lot of tax. And we've seen exactly that happen. So if anyone out there has got sheds that is a temporary storage facility, I would definitely look into whether there's any capital allowances on it. So that's probably the most obscure one. I don't know if you're thinking if that's the type of thing you were looking for.
Yeah, no, that's really interesting. And what about things like lime and drainage and things like that, Victoria? Does that come on?
Well, you would on the basis that I would say with your lime and your drainage, that's already you're replacing what was once in the ground, or that would be a repair and that would already be fully utilised through your profit and loss.
Yep. Next question, Victoria. You mentioned the renewables, and would it be fair to say that renewables have kind of taken a bit of a backseat with the stop to the RHI and the feed-in tariffs? But have you seen sort of more people starting to reinvest in those things?
They did kind of slump for a while, but hydro schemes seem to be a really big one at the moment. So if you've got a section of river on your farm with a big drop, it doesn't need to be a large river, right? It just needs to have a drop. We've got some, tiny little streams that turn over some massive hydro income, but obviously that's large capital spend. I think biomass boilers, obviously on the RHI front, have potentially, had their day on that. But depending on what you're heating, they've still definitely got a place and still are being used by, a lot of our clients. Ground source heat pumps are definitely on the rise. I've seen, quite a few of them just recently. But yeah, it has definitely taken a dip because of the change in RHIs, and who knows what's going to happen when we get to, trying to be carbon neutral, because I sometimes struggle to think of how some of the biomass boilers are actually that friendly, but that's not for me to decide, I suppose.
Yeah, no, I think depending on what direction the policy takes, they may start to play a bigger role going forward. The next question, Victoria, it's more specific to do with holiday lets here. So if you're diversifying into holiday lets, what would the standard rate of VAT be on purchases, and can you sort of claim them back in the same way as you can with for a standalone farm, if it was a farm purchase?
So firstly, if it's a holiday let, you have to decide. So if you're having it within your farming unit and you're VAT registered, you can absolutely claim all your VAT back on everything in your holiday let. But what you need to remember is all your income is then subject to VAT. So you have to basically think that, everything you make, 20% of that needs to go in VAT, which most people obviously don't want to do because your competitors are usually not VAT registered. So if you can get that into a standalone entity, which is not VAT registered, then obviously there's no VAT to pay on your income, but then unfortunately you cannot claim any VAT back on your expenses. So you can't have it both ways, I'm afraid. You either pay it on your income and claim it on your expenses, or you don't have it on either one.
Yeah, no.
I mean, the rates of that, they lowered during COVID, but they are generally subject to the standard rate.
Yeah, that makes sense. And another question here, Victoria, it's about making tax digital. Do you maybe just want to give a little bit of an explanation as to who needs to submit their VAT returns digitally?
Well, I'm going to be upfront here. That is not my area at all. Making tax digital is not something that I am professed to be an expert on. But basically, the smaller companies, we're going to get to a point where everybody needs to be submitting online. Whether the staging dates keep changing, but sorry, I can't be more specific on that one. Just being, it's not really. I'm not up to speed with that one at all.
Yeah, no, that's fine. We can look into that.
I can find out the answer for you from our bookkeeping team, who's contacted we're in the middle of contacting all our clients, but I don't know the different thresholds off the top of my head.
Yeah, no, that's grand. So here's another question. It's maybe again, the capital investment allowance cannot be used to invest in the diversification related items. So I suppose items away from the farm.
The AIAs.
Yeah.
So it depends. Basically, it depends what you're buying. But yes, and therefore, if they're for business items, which is classed as, you know, a business. What could it be? Give me an example of what you're looking for it to be on. You couldn't get annual investment allowance on a property, for instance, or a rental property. That wouldn't work, but because it's obviously it's not seen as a business item; it's seen as an investment item. But yes, if you're going down a different business stream, so if you decided that you want to, a business, building business, and you needed vans to buy, you would be able to claim AIAs on the equipment for that building business. Yes, absolutely.
Yeah, no, it makes sense. Next question, just on the slide you're on there, Victoria, with the R&D examples. Could you maybe this question's more specific. So if you're maybe trying a trial within a field, so saying trying a new crop, for example, that's maybe not been grown before, would the costs involved in growing that crop, or say a failed crop for whatever reason, be eligible for any tax relief, or how does that work exactly?
Essentially, yeah, that's exactly the type of thing that may qualify. So yeah, that's the type of thing you could take further. Absolutely. Yeah,
no, that's grand. So we'll pass on. If anyone's got any more specific questions about that, they can feel free to contact you, Victoria.
Yeah, absolutely. Happy to have a chat with anybody that wants to chat.
Yeah.
Do anything, especially, you know, if it's R&D specific, that would be great. But anything anybody wants to chat about, I'm happy to have a consultation with them.
Victoria, I'm going to put you on the spot now, and I'd just like to ask you, just as a bit of a summary, we are heading into uncertain times. 2024 isn't too far away, as you said at the beginning. And what would be your sort of three key messages for farm businesses trying to adapt themselves to this change?
Yeah, I'd say be proactive now, get yourself prepared, really understand your business and actually understand what makes you your profits. I think that would be definitely point number one. And the second one being make sure you are claiming all tax reliefs that you can, whether it be through having a look back at any capital expenditure you've done, or looking at research and development opportunities, anything like that. And the third one, something happened.
Yeah, you're still there, Victoria.
The third one would be take proactive advice again. So like before you do change anything, get some advice on the tax front and the agricultural side. You know, make sure doing something now is not going to jeopardize something later, whether it be subsidy income or tax reliefs. Yeah,
no, that's I think that's a really good place to finish. And I think that the latest ag bill is due to be released next year, with hopefully a bit more detail as to what the direction travel is. But I think, as you said at the beginning, Victoria, we sort of need to be a bit more proactive and maybe start future-proofing ourselves now, as opposed to just knee-jerking in reaction to sort of government policy, because there's only so much of that you can do before you get caught out. You don't want to be at the sort of support payments are very important, but it just pays to do everything within your own control to try and mitigate any sort of negative effects from that. So no, thank you very much for that. That was a great summary. So I think if there's no further questions, I will just close it there. And I'd just like to say, first of all, a big thank you to Victoria for joining. Fantastic. And I'd just like to say, there will be just a wee feedback form going around, a wee survey. So if you just take a minute or two just to fill that out, and you'll be entered into a draw to win some baked goods. So if you just take a couple of minutes to fill that out, that'd be great. And thank you again for that, Victoria, for joining us. Brilliant. We're hoping to start these meetings again next year. So I look forward to seeing you all back for another round. So thank you very much for joining.